Hey guys, welcome to Andrew Invests and Happy New Year to all of you. It seems the stock market has taken the New Year, New Me message pretty literally and started with a bang. So I wanted to discuss that with you guys and give my thoughts on whether the close approaching earnings season will ruin the party. Um, After all, not many New Year's resolutions get through January. I also wanted to speak a little bit about my predictions for the year, as well as my top stock picks for 2023, the ones I think that will outperform the market, and also give you a little insight into my process for picking individual stocks, and show some of the software I use to do so. Okay, let's start off with a quick portfolio update to put the recent market bounce into perspective. So obviously, as you can see, portfolio is looking a lot healthier than last time I showed you guys. It's up £4,000 or around $6,000. So obviously, I'm pretty happy with that. However, it remains to be seen whether that will stay the case for very long. So if I take you through some of my individual holdings, obviously the ETFs are not as interesting, but are performing well also. So in particular, Alibaba has performed really well. And that's basically just because the Chinese government have lifted all the COVID lockdowns in their country, which has basically led to speculation. Their economy will and consumer spending will recover, and most of their tech stocks and just stocks in general are performing particularly well. So Meta is also pairing some of the losses that it's made over the last year, for me and just for their general shareholders. So that's a welcome sight. I personally think they're quite undervalued, so I really hope this kind of trend will continue, although they are facing a lot of headwinds as well. Speaking of headwinds, Apple is not performing so well. So they've gone through a lot of bad news over the last month, including issues with China, COVID picking up in China, like stopping their factories from being able to produce as many iPhones. And recently, very interestingly, Tim Cook has decided to cut his own pay by 40%, which is a pretty unusual move. And it's led to many to speculate that he may be doing that preemptively before the earnings call in a few weeks, in order to mollify shareholders if the performance is, not up to scratch. So it remains to be seen whether that's true or not. But yeah, it's definitely very, very interesting. And finally, I wanted to talk quickly about Crocs. They've been performing really well. Actually, my best performer. They predicted I think it was around 16% revenue growth for next year, and that's a lot higher than the rest of the rest of other companies in the market. So they're basically performing very well, and they're regaining a lot of the losses they made in the start of 2022. I'm not sure if it's sustainable personally, but I probably will be continuing to hold this company for at least a while, because I got in at a very low price. And if they do well, there's a lot of upside, I think, as they are valued quite low in terms of market cap. Okay, so I just really quickly wanted to talk about why the market is bouncing at the moment. And the main reason for that is because inflation has started to decrease. So that's happening in the US and Europe, also the UK, but to a much lesser extent. It seems that inflation here is a bit stickier, and will be around for longer. So this is a graph of US inflation CPI figures over the last year or so, and you can see that throughout 2021, early 2022, inflation was rising pretty drastically. The Feds basically started to raise interest rates to combat inflation, around about this time. And it's pretty well known in economics that interest rates usually take about 6 months to factor in before they can affect the rate of inflation. And the way that it does affect the rate of inflation is basically by slowing down the economy, slowing down investment. It basically reduces the velocity of money going around the economic system. And that velocity is usually what drives inflation. So by increasing interest rates, it basically makes investors more likely to keep their money in cash. It makes the price of debt go up for companies to borrow money in order to invest it. And lots of companies will lay off employees, for example, and that will reduce consumer spending due to less people in work. So overall, the effect of interest rates is to chill the economy and slow it down because it's going too fast and overheating. And that usually takes around 6 months or so to start factoring in. So we can actually see that pretty neatly here. So in around June last year, that's when the CPI figures peaked, and then they slowly started to decline after that. Meanwhile, the Fed has been raising interest rates still pretty much by 0.75 each time. With this latest figure, it does appear that inflation seems to be on the way to being defeated. So the Fed target rate is for 2%. It's still pretty far above that, but the general direction is correct. So this has basically mostly been driven by the price of energy, to be honest. The war in Ukraine has really driven up energy prices, but in particular recently, in recent times, winter was a lot warmer in Europe than expected, so energy usage ended up being a lot less, and the prices of that began to go down. So we can actually see that if I take this off, you can see how energy was extremely high, at an extremely high rate of inflation. So this would have been oil, gas, anything related to that, so petrol, diesel, and that really started to come down after June. You can see it now coming down to around a rate of 7%, which is a lot closer to normal figures. Obviously food, it seems to be a bit stickier, but it is also slowly coming down. Hopefully that these will all start coming down. You also have to remember that energy really has a huge knock-on effect on to other rates of inflation for other products. For example, delivery drivers will all be using energy in order to deliver their goods via car, train, airplane, etc. So that the increase of price in that basically has a massive knock-on effects for whatever goods are being delivered. With this drop in inflation for that, those knock-on effects should be reduced, and hopefully we will see inflation start to go down. And in fact, many basically predict that we have already seen peak inflation, although that obviously remains to be seen. So over the last week, we had a particular shift in mindset where basically the market really started to predict that the Fed wasn't going to have to raise interest rates as highly as what it was predicting before, because the market basically is predicting now that inflation probably won't be as bad as what was initially feared. So we can see here a graph of the US Treasury yields. Basically, the US Treasury yields are directly correlated to what the market expects the average interest rate of the US to be over the time period of that bond. So for example, here, this is a 2-year Treasury bond. So the market is currently expecting around a 4.23% interest rate average over the next 2 years. And earlier on in the week, it was expecting closer to 4.5. So the fact that that's dropped a lot has basically indicated that the market thinks that the Fed will have to slow down their rate of interest rate increases and eventually start dropping them. So that is basically what is causing the recent rally in stocks. In general, the price of stocks are inversely correlated with the yield on treasury bonds. And basically that is due to treasuries being a safe asset, and basically it's never expected to fail, right? So if the interest rate on a completely safe if the yield on a completely safe asset is 4.3%, why would you own a stock that has a high amount of risk for a yield that's less than that potentially? In general, stocks have yielded 10% per year over the last few decades, but that trade-off between risk and yield is like a really important factor in determining what the general price of stocks are. And that's why stocks have started to rally over the last few weeks. So I personally don't think that we're at the bottom just yet. That's because if you look at this graph here, this is a general graph of the psychology of a market cycle. So if you look at this graph, you can see in basically 2021 was the euphoria phase where everyone thought they were going to be rich. Crypto stocks were going crypto was going crazy, and meme stocks were going crazy. Everyone and their mother was invested into the market basically. We really started to see in 2022 a decline. Like a big decline, but I really don't think it was at the end. Like if it was a real kind of drop, you would have seen a lot more panic and people selling out of the market. However, we saw that there was a huge amount of retail customers still buying into the market. You can see right now just on the recent news of inflation going down and yields dropping. It's not only stocks like Meta, blue chip stocks, like good stocks that are going up, but also things like GameStop. So GameStop is up 28% in the last 5 days. AMC is up 30%. These are all meme stocks, which are basically just a quick get-rich scheme for people on Wall Street bets, which have no real inherent value and are basically the only value is the fact that they're a meme. It's effectively you're trying to buy something and sell it off to someone who will buy it for a price higher than you. There's no real fundamental values behind these valuations or increases. You can also see the same in Bitcoin, which is a pretty speculative asset. That kind of tells me that there's a lot of froth still in the market, and we're definitely not at the phase where it's 100% capitulation, where people are getting out of the market. They think that it's the end of the world, So personally, I think we're still around this phase, complacency phase. Obviously, this is only a rough guide, but I don't personally think that this rally will hold for very long. So in particular, I think that earnings season coming up will be a bit disappointing for many companies. There's lots of articles to suggest that consumer spending is up in the last over the holidays. Holiday sales are up 7.6%. That's that's in spite of huge inflation, basically raising prices to the point that people aren't able to buy as much as they were last year. However, the composition of what people are buying has massively shifted. So, for example, people are buying much more clothing, consumer staples like food, and buying a lot less jewelry and electronics. So that bodes badly and poorly for luxury stocks. Like Apple could be considered a luxury stock, things like Tesla, basically anything that is not anything that's like a discretionary purchase. So I think the earnings season will be disappointing personally. I do think that by the end of this year, we will see a rally that will hold. But obviously, no one can predict the future. This is just what I think. There's no point timing the market anyway. I tried to buy into the market in regular intervals, and that means whether I buy at the top or the bottom, ultimately I'm going to average in with the general direction of the market, which over the long term is always up. And that's my plan. I hope you guys agree. Thank you for watching my video. I'm going to cut it a bit short this time, but next time I will show you guys my process for actually picking stocks.